When you look at the macroeconomic trends like inflation and interest rates, India may not follow a similar trend like the global uh, partners. For instance, in the US, there is a significant chance of the overall import tariffs going up, and that could lead to a higher inflation there. But from an India landscape, inflation is moderating here. Interest rates are likely to come down. And in this kind of a scenario, there is a very good likelihood that the growth rates could pick up, which in general is conducive for equity. But when you design your portfolio strategy, you should always have a long term focus. And therefore, you should not focus on what could transpire in the near term, because near term is always difficult to predict, while the long term trajectory is more likely to follow a secular growth story like we have seen in the past several years. Uh, when we look at the current market valuations are near long term median, which means investors would benefit from the earnings compounding which would happen from here on. And therefore, as equity investors, you should stay focused on the long term trajectory and remain invested in equity funds which has a long term view. From a portfolio perspective, what we generally advise investors is to have a 12-20-80 formula, where you should have a safety net which can be 12 months of your expense or even 24 months of your expense, depending on your comfort level. And whatever is remaining, the investment corpus can be split between equity and gold in the ratio of 80-20. The reason why we recommend gold to be a good portfolio diversifier is based on historic trends, where you have seen that whenever markets are worrying about economic scenarios like Russia-Ukraine war or even the global financial crisis, whenever the macro shocks happen on the economy, gold tends to do well, which may not be the case with equity. And during such times, it can be used as a good diversifier or a rebalancing tool, wherein you can rebalance the higher weight or the gain which you accumulate in your gold towards more equity allocation, which could be at suppressed valuation at such times. So, if you want to follow a long-term portfolio strategy, this is a very simple solution to have a safety net, which could be your 12 months of expenses or even lower or higher, depending on your risk appetite or the stability of your income source. And the rest of the portfolio can be split between equity and gold in an 80-20 proportion.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.